Okay, good morning. Can we get started, please? Thank you. Appreciate you getting to class on time so we're not disrupting the video by walking in 5 minutes late. So we want to continue right along with our introduction, and so I'll pick up where I left off. We were discussing the very basics of what a futures contract is. And there are four basic categories of futures contracts. We discussed some examples on Monday. So there's a category called metals, and there's a lot of attention at the present time focused on the gold futures market. So you might look at the gold futures market. Gold has become favorable again. Part of the explanation has to do with the declining value of the U.S. dollar. So there's a movement out of the U.S. dollar towards gold, and gold has been rising recently. There's another group of contracts called natural resources. Many of these are traded on the New York exchanges. And one contract that I use frequently as an example is crude oil. If you've subscribed to the Wall Street Journal, you'll see today's article on the futures and options page discusses what's going on in the oil market. Oil has risen in the last few days due to a meeting last week by OPEC, which is the oil cartel. And at that meeting, it turns out that representing Iraq was an American. And this upset some of the OPEC members, and so they're a little concerned about increased production from Iraq right now. There's very little production. The industry's in shambles. So they decided to reduce production, OPEC, by 3.5%, and that sent prices reversing. There was a general feeling that the price of oil was on the way down following the war. However, it reversed this week, and so you'll be reading a lot about the crude oil market in the Wall Street Journal. In terms of financials, we have exchange rates. The euro is the single European currency. Please don't confuse it with the euro dollar. The euro dollar is an interest rate contract that's based on short-term interest rates that are paid on dollar deposits in foreign banks. It's largely based on what's called the LIBOR rate, L-I-B-O-R, which stands for the London Interbank Overnight Rate, which pays interest on U.S. dollars that are deposited in European banks. So the euro dollar is an interest rate contract. The euro is obviously an exchange rate. Europe has gone to a single currency. And then we have stock indexes. There's a lot of action right now in the stock market. You might consider trading one of the indexes, partly because there's fear again about economic growth or lack thereof in the U.S. economy. Okay? Can I ask you to come to class on time, please?
Yeah, I don't have it.
All right. I think I'll start locking the door on Friday. So there's concern about the extent to which the American economy is going to grow, and therefore the stock market's been off in the last week or so. That has fed into the currency markets. There's a general belief that the U.S. dollar is probably overvalued and will weaken. Good morning. You're late. And as a result, there's strong pressure on certain central banks, for example, China's, which actually has a fixed currency, and we'll talk about that later. But there's pressure on Japan to allow its currency to strengthen, the Japanese yen, which would weaken the U.S. dollar. The U.S. dollar has been weakening against the euro, but there's a general belief that there's a lot of pressure that's building up to further weaken the U.S. dollar. So you might read about the currency markets, and of course that's related to the stock market. And to some extent these factors tend to feed on themselves. I'll get your question in a second. And tied in with that, of course, is the the T-bond contract. I don't have it listed there under financials, but another very important contract is the Treasury bond contract at Chicago, which is a long-term interest rate. The Eurodollar is a short-term interest rate. The U.S. government, as you know, we've gone from a surplus to a deficit, and one way that the government is raising money is by selling bonds. Overseas banks are very large purchasers of bonds. Banks in Japan and China and Europe account for a very large share of bond purchases. So those banks have been buying U.S. bonds, which is driving up their price, which is driving down the interest rate, which is helping the U.S. economy with a low interest rate. If they decide that the U.S. dollar is going to weaken, and they decide that the U.S. stock market is going to start slipping again, these banks might withdraw their purchases of bonds. That will send the price of bonds plummeting and interest rates rising. Of course, if we have a rising interest rate and the economy is slowing down, that will simply exacerbate the situation. So many of these markets are interrelated. You had a question? Right. You can now. Question is, can you buy futures on individual stocks? That's something that's very new. It was started probably 15 years ago, but never really succeeded. And about a year ago, some of the exchanges introduced single stock futures. You see that single stock futures are also traded in other countries such as Australia, but it's something that's very, very new. So at the present time, there's not much volume. And as far as I know, you can't find those on StockTrack. I mean, StockTrack allows you to trade the large volume contracts. So you could trade, you know, crude oil, euros, Eurodollars, major stock indexes on StockTrack, but not single stock futures. Okay. And then we have, of course, the agricultural futures, and this is where it all started. The large ones being corn, wheat, soybeans, cattle, and then what are called the soft commodities, such as coffee and sugar, which is kind of interesting because in the case of sugar, there are two contracts. There's a U.S. domestic contract and a world contract because the U.S. has a very large tariff on sugar imports, so the price in the U.S. is about double the world level. So you'll find there's two contracts there, one domestic and one foreign. There's been a lot of attention in the last few months devoted to the coffee market. The coffee price has been in the doldrums, so to speak, and this has had a very significant impact on many developing countries. You can also trade cotton futures. The price of cotton has also been in the news lately because countries in West Africa are concerned about the price-depressing effects of U.S. farm programs on the world price of cotton. So there are plenty of interesting contracts that I would like you to consider for StockTrack. As I said last week, don't try and do them all. Pick 2 or 3 contracts. Do some background reading in the Wall Street Journal on the web and other sources, and then you can start trading. Okay? And I'll go to the StockTrack page later this morning. I'll come back to some of these graphs. We did look at a graph last time we met, and the purpose of those graphs is just to illustrate how the pricing of these contracts work. So let's talk about the specifics of a futures contract. So as I said, as the name implies, a futures contract is a contract whereby a willing buyer and seller establish a price today for a future transaction. Now, it could result in a deliverable transaction or a non-deliverable transaction, depending on the underlying contract. Let's leave that aside for a second. So every contract must have a willing buyer and a willing seller. The contracts are standardized. If we think about December crude oil that's traded on the New York Commodity Exchange, December crude oil is highly standardized. It specifies a certain volume of oil. It's 1,000 barrels. Every futures contract for crude oil is 1,000 barrels. They're all the same. It specifies a certain quality of crude oil. It's a light, sweet crude oil, so it has a very specific quality specification. It specifies a delivery point. In the case of crude oil, it happens to be in a pipeline in Oklahoma where there's a lot of oil traded in the spot or the cash market. So all those characteristics of the contract are fixed by the exchange. And if you look at the exchange website, you can find details on one of these contracts. The contracts that you decide to trade on StockTrack, I suggest you go to the appropriate exchange and have a look at the contract specifications. It just gives you a better idea of what you're trading. So every contract will, of course, have different specifications. In the case of crude oil, everything is standardized. You have different delivery months. We saw last time in the case of crude oil, you can trade for delivery in December 03 all the way up to December 09, I believe, was currently on the market. So for each of these different delivery months, if there's trading going on today, well, there's a buyer and a seller that are willing to take opposite sides of a position for future delivery of crude oil. Somebody's willing to agree to buy it. Somebody's willing to agree to sell it. And let me be clear, when you're buying a futures contract, you're not taking possession immediately. It's not like buying stocks or equities. You're not taking possession of the oil today. You're agreeing or you're promising, it's a legal agreement, it's a commitment to take delivery in the delivery month. So you're agreeing to take delivery in December, and we'll agree on a price today. Or you're agreeing to deliver in December, and you're agreeing on the price today, depending on what side of the market you're on. So in a way, it's just a type of forward contract, and you might be familiar with other forward contracts we have in our economy. Probably many of you have signed apartment leases. That's a forward contract. You sign a lease for 12 months. You're agreeing to pay rent in the future for a specific piece of property, and the landlord's agreeing to rent it to you, and you agree on the price today for next month and every month thereafter. If you buy an airline ticket, that's a type of forward contract. If you bought a ticket to go home for Thanksgiving, you agree to pay a certain amount today, and in fact, with an airline ticket, you probably pay it up front, and the airline promises to deliver a service to you. They promise to carry you from A to B come Thanksgiving. So it's not as though in everyday life we don't enter into forward contracts whereby today we agree on a future transaction and we establish the price. The difference with regard to futures contracts is that the contracts are standardized or they're homogeneous. Every apartment is slightly different, right? Every seat on the airplane is slightly different. Some people prefer to sit in the front, and they're willing to pay more money for that. So, every airline is slightly different. So it's not exactly a homogeneous product. With futures contracts, as I said, every contract is identical except for the delivery month. And for a given delivery month, the contract is identical. If you bought a December crude oil contract yesterday and you turned around and sold it today, well, you would sell an identical contract. The only difference might be the change in price. And the exchange establishes all these rules of trading. It's regulated by the government. It sets down all the specifications of the contract. And it's the traders, it's the buyers and the sellers. In the U.S., they're in a trading pit, they're in a physical location. They're the ones that establish the price. The exchange doesn't set the price. The exchange sets all of the terms and conditions except for the price. Okay, I've already touched on many of these points, but I'll just review them very quickly. And we can use crude oil as an example. Okay, type of deferred delivery. Yeah, I agree. You can buy or sell oil for 5-6 years into the future. Obviously, it's deferred delivery. The prices are public. At every exchange, there are employees of the exchange who observe the trading on an ongoing basis. And I'll show you a video next week. It's pretty crazy on a trading floor. There's a lot of shouting and pushing and a lot of paper that's flying around. But that activity is recorded and it's broadcast around the world. So no matter where you are, you could be sitting in Davis or you could be sitting in Beijing or wherever. If you have access to a computer screen or a telephone, you can find out what the price of crude oil was 15 seconds ago, 10 seconds ago on the New York market. And that is the world market for the price of crude oil. If you want to find the price of cotton, well, you go again to the New York market. That's the world price of cotton. The price of wheat, Chicago Board of Trade. It's the world price of wheat. Information regarding supply and demand feeds into that market through the traders. It's reflected in a price, and it's public. The markets are generally considered to be highly efficient, to do a very good job of transferring this supply and demand information into the price. In fact, a few years ago, there was an economic study done on the efficiency of these markets, and it was compared to large-scale commercial firms who also forecast prices. So you can think of the market, one way to interpret these deferred prices is a type of forecast. If you look at the price of December crude oil 04 or 05, you can think of that as a forecast of where the price of crude is going to be in 2 years or 3 years or 4 years, and so on. So you can view it that way. There are many commercial firms in the U.S. and elsewhere that are highly, I should say their profits are highly related to prices in these underlying markets. For example, if you're a manufacturer of farm equipment, you're John Deere, and you're selling tractors and harvesters, well, the price of corn next year is really critical to how many pieces of equipment you might sell. If the price of corn is up at $5, you probably sell everything you can produce. If it's down at $2, chances are you won't. And it's not as though you can turn out a piece of equipment in 3 weeks' time. It takes many weeks to manufacture such a piece of equipment. So these people have to forecast ahead, and it's very, very critical to the health of the company. And there are plenty of examples. You can think of why the price of crude oil might be important to firms and so on. So these companies will sometimes purchase professional forecasts. And there are economists out there who can build large-scale models. Many of you have taken econometrics, right? And you've learned about econometric models, which are basically statistical models that might be used to forecast. So we could build a model of the corn market. And it might have 50 equations. It might have 200 equations. We have to account for stocks in China. We have to account for weather patterns in Brazil. We have to account for what's happening to the livestock sector in the European Union, and so on. So you could imagine it could get very complicated very quickly. But we could build such a model and use it to forecast the price of corn. We know that the price of corn will depend on supply and demand, on inventories, exchange rates, all these factors we put into our model, and we can tell the CEO of John Deere, yes, next year the price of corn is going to be $5 a bushel. Okay? And firms do that, and they make a lot of money doing that. Then they will charge a company like John Deere, tens of thousands of dollars a year for providing these forecasts. So a couple of economists thought, well, this is sort of interesting. Another alternative for the CEO, instead of paying $50,000 a year for this forecast, what if he subscribes to the Wall Street Journal, right? That's $30 a year, whatever it is. And what if he does that? And what if he knows how to read the futures page? Well, he can turn to the futures section, and there is a price of corn for December 04. And he could use that as a forecast. And it's a heck of a lot cheaper than subscribing to these large-scale models. So over the long run, which strategy do you suppose gave the better forecast? Reading the Wall Street Journal or buying these large-scale models? Pardon? Wall Street Journal, thank you. You knew where I was headed with this, right? The Wall Street Journal. It's another pitch for the Wall Street Journal. Yes, you can save a lot of money by looking at what the futures market is saying with regard to next year's price. And all this says is that the market does a better job than anything else out there in terms of forecasting prices, which is not a big surprise. So you could spend a lot of money trying to beat the market, and you could still fail. It's not a big surprise, because what is the price of December 04 corn? Well, it simply reflects what buyers and sellers on the Chicago Board of Trade think the price is going to be next year. They're willing to put their money on the line, and many of them have done research or they're involved in the corn business, so they're willing to put their money on the line. So lo and behold, it's a pretty good forecast, right? It's just like the Iowa markets that we talked about. We discussed the fact that those Iowa political markets do a better job of forecasting outcomes from elections than opinion polls, right? Has anyone checked how the Arnold contract's doing? It's going up? Let's have a look and see. Let's see here. So I'll go to the class web page, and we looked at news futures, I think, last time. Is that the one you were checking? Or? And I think the first day we looked at news futures, it was Arnold's probability was around 30, right? I think now it's over 60. But if we look at, I mentioned this Iowa market to you the other day. If you click on the Iowa exchange and you click on political markets, they have something called the 03 governor recall ballot 1 and ballot 2, because there are two ballots, right? The first ballot is, should there be a recall, and the second ballot is who should be governor. So if we click on this, this gives us some description of the contract. And essentially, as I said last Friday, this contract will take on a value between $0 and $1. And on the Iowa market, the buyers and sellers actually use real money. But there's a maximum. I think you can trade is $500. So it's not as though you can go in with $100,000. But it's real money that you're winning or losing. And so the contract ranges from 0 to 1. And if the event happens, then it will take on the value 1. If it doesn't happen, it'll take on the value 0. And then they have some alternative ways, too, of trying to predict the election. But if we look at, let's see, this is the current ballot. Pardon me? Anybody can trade, yeah. Anybody. So I know this is hard to see, but can you see this brown line on top? This refers to GD. Now, who do you suppose GD would be? Gray Davis. Gray Davis out, all right? So the probability that Gray Davis, you can interpret this as a probability because if Gray Davis gets kicked out, then it becomes 1, right? If he doesn't, it becomes 0. So it started off back in August pretty high, about 0.7, was pretty flat, and then it started to fall as Davis's stock started to rise again, right? And there was this court injunction that appeared it might halt the election and all this stuff. So then it fell back down to below 4, but then look what's happened recently. It's now up to 0.9. So since the debate, this contract, the price of this contract has really soared, okay? And let's see. I want to find ballot 2. Here we go. Here's ballot 2. Okay, let's try to focus on this green line. I don't know if it's possible. Can you even see it back there? Okay. The green line is the contract on Arnold. And remember, so this is a different market than what we looked at last week, but the prices are fairly similar. This one is, I actually put a little more weight on because it's real money. And this one has a longer history. And this is the market I referred to that does a better job than opinion polls because the people that are trading, for the most part, are pretty well educated. They put their money on the line, and it's not a big surprise. So this contract, this green one, is ballot 2, B2, win Arnold Schwarzenegger. So it started off around 0.4, a 0.4 probability that Arnold would win. And it went up a little bit, then it was fairly flat. And then it started to fall, and it actually came down to around 0.25, 0.3. But look what's happened recently. That's this green line has risen dramatically, and it's now up to 0.9. The line for Cruz Bustamante has just gone the other way since the debate. So you know, here's sort of a fun example of what I was referring to in the crude oil market or the corn market or any other futures market. The information changes quickly, right? And we didn't know how the debate would come out. The market was hesitant going into the debate. If you could have predicted the outcome of the debate, you would have made a lot of money. And the market quickly adjusts to new information. So as soon as the debate was over, then the prices quickly adjusted, and one candidate went one way and the other candidate went the other way. So according to this market, it's consistent with the poll that was released on Monday. We'll have a new governor whose first name is Arnold. Okay? Any questions on that, on the Iowa market? Do you understand how it works? Yes.
So how does the prices change? Is it someone just says
buyers and sellers? Yeah.
So I would go and say we're willing to pay 90 cents, and somebody's willing to sell it for.
Right, 90.
So
Yeah.
does it go all the way up to 99 cents?
It will go a little bit higher. It depends who wants to pay 99 cents, but if somebody wants to pay 99 cents, yes. Yeah. I would imagine it won't go too much higher. You know, Arnold could drive his Hummer through a check stop and get arrested, you know, before the election. Who knows? So anything could happen. So probably won't go to 99. But I'm sure his bodyguards will take care that that doesn't happen between now and the election. So the price is established by buyers and sellers. And you can if you go to the site, you can see bids and asks. Okay, you can see prices that people are willing to buy at and prices that people are willing to sell at. And of course, they have to meet, the bid price has to meet the asking price before a contract is executed. Yes?
So if we check this like the day before the election and it's still at 90, you said we can buy on this one?
Yeah.
So you could make a 10% gain.
Yeah. Mm-hmm.
On that.
Yeah. But, you know, if somebody's willing to sell it to you. Yes?
Is there a certain limit on how many contracts there are?
Well, you guys are getting interested, huh? I don't know the answer to that question. I think the most you can trade is $500 worth in this market.
Is
So,
there like only a certain quantity in the market?
oh, total? No, no, absolutely not. No. Somebody asked me a similar question, and maybe it was you after class on Wednesday, and I should maybe just clarify that. Today's Wednesday, isn't it? Monday. So, you know, we're referring to the corn market, and we'll just use that as an example. So there's a certain volume of corn produced in the U.S. every year, right? It's a lot, actually. It's about 10 billion bushels. And there's a certain volume that trades on the futures market. And, you know, is there a one-to-one relationship? And the answer is no. For the simple reason that a commodity like corn or oil or any of these other contracts will actually change hands several times from the time it's produced until it reaches its final destination. Excuse me, whether it's a box of cornflakes or a feedlot somewhere. So for that reason, you know, you have the growers that produce the stuff, you have merchants that buy it, you have merchants that store it, transport it, process it, etc. You could have the same product changing hand 5 or 6 times. And all of those individuals might be trading futures contracts. You also have speculators. So for every bushel produced, there could easily be 4 or 5 traded on the futures market. In the case of, you know, this political market, well, it's not a deliverable commodity because it doesn't exist, right? It's just the outcome of the vote in the election. It's sort of like the S&P 500 index. It's a variable that will change from day to day, but you can't actually deliver it. So there's really no fixed volume of this asset. It's not even an asset, right? It's just a theoretical construct. It's an index. So the volume of trade on the market is not constrained. The only constraint is the number of willing buyers and the number of willing sellers. Okay? So do you have any questions on what the futures contract is? Do you understand what I've said this morning? If you're, I'm a little concerned because you're such a quiet group. Maybe you're just polite, I don't know, beginning of the quarter. But the material in this course sort of increases at an increasing rate. And if you're not with me the first few weeks, then it gets very difficult. Yes?
I just want to clarify, when we start, the first thing we have to do is to buy a future. You can't sell it if you don't have anything to sell.
Okay, good question. The question is, and I'll go on to StockTrack this morning and we'll make a trade. The question is, when we start StockTrack, and I hope you start trading on Friday, you should be opening your accounts, looking at the website, do we have to buy before we sell? And the answer is no. You can either buy or sell. And that's an important question. It's an important concept, and it helps you understand the basics of these markets. And that's one reason I want you to trade StockTrack, so you really get a handle on that concept. So when you think about it, the futures contract is really an agreement between a buyer and a seller. So if we're talking crude oil, what's your first name? Christy, okay. If we're talking crude oil, suppose that I'm an oil trader and you're an oil trader, and we're both speculators, okay? And I happen to think that this production in Iraq will not materialize. There's no way they'll get their act together, and we won't see this additional supply on the market that OPEC is worried about. So that's where I'm coming from. Christy knows better than me. She has some information that actually this production will come on stream before Christmas and is probably going to increase the supply of oil. So we have different expectations, but that's what markets are all about. Right? We have different expectations regarding the price of oil. So I call my broker and say I want to buy 10 December contracts, crude oil. Same time, Christy calls her broker, says I want to sell 10 December contracts, crude oil. And I give a price, let's say it's $30 a barrel, you say $30 a barrel, and our orders meet on the floor of the exchange in New York, and boom, we're both in the market, right? I have bought, you have sold. So what sort of contract have I entered into? At this point, as I said on Monday, I only put up a margin, a small percentage of the total value. Each contract is 1,000 barrels. So if I buy 10, that's 10,000 barrels. For each contract, the total value then, if it's $30 a barrel, would be $30,000, right? But I only would deposit around $3,000 for each contract. That's my margin. And you'll see that when you trade StockTrack. Why can I buy 10 contracts or 10,000 barrels for $3,000 each? Is because at this point, I am only agreeing to buy oil in December. I'm not actually buying the oil. When we make that trade, and you can think of both of us being on the floor, I am saying to you, all right, Christy, I want to buy some oil in December, and I'm willing to pay $30 a barrel.
So in the future, would I have to buy some to sell?
Well, okay, I'll get there, okay? And so that's what I'm saying. Okay, I want to buy some oil, and I promise to buy it in December. I don't want to buy it today. I promise to buy it from you in December. And you look at me and say, okay, fine. I promise to sell it to you in December. In December, I'll sell you 10 oil contracts or 10,000 barrels. And then we have executed a futures trade. Now, it's quite possible that you don't have any oil. That's quite possible. I assume you don't have 10,000 barrels of oil, right? And it's quite possible I don't really want the oil because I'm a speculator. But that doesn't mean we can't promise to buy or promise to sell, because in the futures market, it's very easy to reverse that promise. So you can say, yes, I will sell you 10,000 barrels of oil at $30 a barrel, knowing full well before December rolls around that you can reverse that position. And because every contract is the same, it's standardized, it's very easy for you to reverse the position. You call your broker and you say, buy 10 December oil. So your order goes in, somebody's on the other side wanting to sell at that time, your orders get matched. So today, October 1st, you sold 10 barrels. Let's say on October 30th, you bought 10 barrels. They cancel one another. You've agreed to deliver 10 barrels in December, and then later on, you agreed to accept delivery of 10 barrels. And those agreements are offsetting, right? One's the opposite of the other. So you're out of the market on October 30th. The only thing that's happened is the price has changed. And for your sake, I hope the price has gone down, because you thought it would go down because Iraq's going to increase production. For my sake, I hope it went up, right? I think it's going up. You think it's going down. One of us will be right. The other one will be wrong. One of us will make money. One of us will lose money. And your profit or loss just depends on the price change. Does that answer your question? Or? So a very short answer to your question is you can sell something before you buy it, because in the futures market, you're only promising to sell. Underline the word promise. It's an obligation at this point. You're not actually selling it. Yes, sir?
Is a futures contract like an option, like a stock option contract, in that the third Friday of the month is the actual date where
Delivery?
yeah.
No, no. Question is the futures contract like a stock option where the third Friday of the month it expires? The answer is no. Again, I suggest you look at least one contract specification, okay? Whether you're trading crude oil or bonds, I don't care. And they all differ slightly. But basically, with a futures contract, delivery will start the first business day of the delivery month. So in the case of oil, we're talking December 03. So if I bought a December '03 contract, and let's suppose I bought it 3-4 years ago, so I've had this contract for a long time, the first week of December rolls around, I've agreed to buy the oil. Now, there will be some deliveries. Some people actually want to deliver the oil. So if I've had it for 2 or 3 years, chances are I'll get a phone call the first week in December saying, oh, by the way, your oil's been delivered in Oklahoma. Send us a check for the full amount. So delivery can start on December 1st, and it will run through most of the month. Most contracts will expire, a few days before the end of the calendar month, but delivery can actually take place over about a 3-week period. And so if you want delivery, if I wanted the oil, I just buy a December contract. I could buy one today and just wait. If I bought one today, we're almost at December, probably December 20th, I'd get a phone call saying your oil's been delivered. Pay the full amount. And there I go. I've got 1,000 barrels of oil sitting in a pipeline in Oklahoma. So I'll get a piece of paper that says I own that oil.
What about like stock index?
The stock index is non-deliverable. There are many contracts that are non-deliverable. Stock index, you can't deliver it, right? So it is settled on the expiry date, and again, that date will be sometime towards the end of the contract month, and we'll have to check the specs. I don't know offhand, but let's say it's December 20th. So on December 20th, there will be some open positions. I bought some indexes, you sold some indexes, and they have to be matched. For every buyer, there has to be a seller. And then when we get to that date, if there are still some open positions that haven't been reversed, then the exchange, actually it's called the clearinghouse, and we'll learn about the clearinghouse, they will reverse your position at the cash price that day, right? Because the stock index is based on either the Dow Jones average or the Nikkei average or the S&P 500. It's based on one of these indexes. And the price of each index will, changes from minute to minute, right? So whatever the price happens to be on the close of business on December 20th, that's where your contract's reversed. And that's true for all non-deliverable futures contracts, okay? Yes, sir.
What happens if you get a futures contract and on the delivery date you just decide you don't want to pay for it? Like, what do they do?
Okay. What are you planning here anyway? So the question is, if you have an open contract and you get one of these phone calls and you basically don't pick up your phone, is that what you're asking me? Well, that's why we'll talk about the clearinghouse, because these exchanges are regulated. In the history of U.S. markets, and it goes back 150 years, there's never been a default on trading, because the members of the exchange, the large brokerage firms that will actually execute your trade, they're the ones that are on the hook, okay? It's not you or I sitting in Davis. We go through a broker, we pay them margin money, but they're the ones who are ultimately responsible. So if we flee the country, they're the ones who must honor their side of the position. And if they don't, the clearinghouse will. And we're getting ahead of ourselves a little bit, but we'll get there. Oh, thank you. Okay, let's just have a quick look at StockTrack. Again, I'd like you to register by Friday. So this is their home page. And you register by going over to this side of the page. There's an introduction. You have an account number on the class website, right? I've put a PDF file on there. You can find your account number. If for some reason you can't find your number there, send us an email, either myself or Montisha, and we'll assign you a number. And please register. And once you register, or even before, you can sort of browse this website. They have a lot of information here. So I have an account, and I just want to show you how to make a trade. So once you have your account and you decide it's time to trade, then I clicked on Make a Trade, and it opens up these different trading pits, right? So we are going to focus on futures. I mean, if you really want to, you can trade futures options, but I think we're getting ahead of ourselves a little bit. But I won't get too upset if you trade futures options. So basically, these are the two pits I want you to visit, okay? Do not trade stocks, do not trade bonds, or anything else, because I get reports weekly from StockTrack, and if you're trading one of these other pits, that's not what we're doing in this class, okay? We're focusing on futures. So we'll go to the futures pit. And you have to type in your account number, and be sure you use the capital A, which comes in front of it. So you type in your account number and your password, and then it says, what type of trade will this be? Okay, so it gets to Christy's question. You can buy to open or go long, it means the same thing, or increase a long position. So you can buy a contract to initiate a long position, which means you buy, or you can add to an existing long position by buying more contracts. You can sell to close a long position. So you wouldn't do that initially, because if you don't have a long position, you can't close it. You can short to open a position. So that's what Christy was asking. Can I sell to open a position? And then you can buy to close a previously short position. So why don't I click on short to open a position? Okay? I'm going to click on that. It says number of contracts. I'll be brave. I'll type in 3 contracts. And then it says, please click on the futures contract you wish to trade, the type of contract, the category. Okay? Well, it's not letting me do that. I was going to trade in interest rate futures. I should be able to click on one of these, but for whatever reason, it's not cooperating right now. But you get the idea. You make 2 choices. Either you buy to go long, or you sell to go short initially. That's your first trade. You choose the number of contracts. So you have $200,000. You can check the margin amount on StockTrack. Don't get too carried away. Then you choose your number of contracts. You choose the category. If you want to go to interest rates or currencies, then it'll give you a choice. Yes? Hang on, please. Thanks. Yeah, you have to sign up. It's $18. Yeah, but it's not real money. It's play money, right? You have $200,000 to start, and then there's a commission fee for each trade. I think it's $50, but it's play money. Okay, thank you.